Today at 2 p.m. Eastern Time, Jerome Powell stepped to the podium for one of his final press conferences as chair of the Federal Reserve. And what he said, and what he did not say, has left every gold and silver investor in the world asking the same urgent question. Did the Fed just feed the bull market, or did it just kill it? Today, I'm going to give you the complete, honest answer. What the Fed actually decided, what the dot plot revealed, what Powell said at the press conference, and most importantly, what it all means for gold and silver in the days, weeks, and months ahead. Let us start with the decision itself. The Federal Open Market Committee held rates steady at 3.50 to 3.75%. That part was exactly as expected. A 99% probability of a hold according to CME FedWatch. No surprise there. The market had already priced it in. The real story was the dot plot. And the dot plot delivered a message that precious metals investors did not want to hear. The median dot for 2026 was held at one rate cut. Just one. But the more alarming signal came from the distribution. 7 FOMC members now project 0 cuts for all of 2026. The inflation forecasts were revised upward. Core PCE projections for 2026 were raised to reflect higher energy costs from the Iran conflict and stickier services inflation. And the summary of economic projections confirmed what the hawkish members of the committee had been warning. The geopolitical tax from the Middle East war has raised the bar for the next cut significantly. Powell at the press conference was careful, measured, deliberately ambiguous. He acknowledged that growth has softened, noting the 0.7% annualized Q4 GDP figure and the negative February payroll print of minus 92,000 jobs. He acknowledged the unemployment rate has climbed to 4.4%. He said the dual mandate is no longer pulling in one direction. But then he said the thing that the gold market was dreading. He said core PCE remains stuck well above the Fed's 2% target. He said the implications of the Middle East conflict for the U.S. economy are uncertain, and he said the committee is in no hurry to adjust policy. In no hurry to adjust policy. With core inflation at 3.1%, with oil above $100 per barrel, with a war driving energy costs higher. That is the hawkish hold that Investing.com, Oanda, and EBC Financial Group had all warned about before today's meeting. So did the Fed feed the bull market? Let us look at both sides honestly. The case that the Fed hurt gold and silver goes like this. A hawkish hold is textbook bearish for non-yielding assets. When the Fed signals higher for longer rates, real yields rise. Treasury yields climb. The dollar strengthens. And gold and silver, which pay no interest, become less attractive relative to bonds that now pay more. Financial Content published analysis predicting exactly this outcome. If the Fed maintains its hawkish tilt, gold could see a further correction toward $4,800 support, while silver may retreat toward $75. The dollar index has been strengthening ahead of this meeting. The 10-year Treasury yield climbed back above 4.20% in recent sessions. These are exactly the conditions that have been suppressing precious metals for the past 6 weeks, since silver peaked at $120 and gold hit $5,595. Today's decision does not change those conditions. It extends them. And the leadership uncertainty makes it worse. Powell's term expires May 23rd. Kevin Warsh is waiting to take over. As MEXC's analysis confirmed, markets are already attempting to price in a potential shift in Fed philosophy under Warsh, which adds volatility to an already complex environment. We are in what Oanda described as a lame duck period. The market does not know who is actually setting rates by summer. That uncertainty suppresses risk-taking and keeps safe haven flows more muted than they would otherwise be. But here's the case that the Fed accidentally fed the bull market anyway. Powell could not ignore the economic weakness. He acknowledged it directly. He said the dual mandate is no longer pulling in one direction. That single phrase carries enormous weight. It means the Fed is watching both inflation and growth simultaneously. And when growth continues to weaken, which the data suggests it will, the Fed will be forced to cut regardless of what the dot plot says today. As USAGold's analysis of gold's response to the December meeting showed, gold prices held firm despite hawkish guidance because the market effectively looked past the Fed's rhetoric, betting that the rising unemployment rate would force the central bank's hand in 2026 regardless of their current signaling. The same dynamic is at work today. Powell can say he is in no hurry, but the data is moving in a direction that will eventually demand action. And the structural bull thesis for gold and silver has not changed by a single ounce. Central bank buying continues. De-dollarization continues. The global shift of BRICS nations away from dollar-denominated reserves continues at a record pace. The Silver Institute has confirmed a 6th consecutive year of structural deficit. COMEX inventory drain continues. Physical premiums in Eastern markets persist. JP Morgan holds 750 million ounces of silver on the long side. Bank of America maintains its $300 silver target and $6,300 gold target. UBS maintains $600 to $100 gold by year end. None of those structural drivers were decided by today's dot plot. None of them respond to Powell's press conference language. They are real-world physical forces that exist independently of what any central bank says from any podium. Market Pulse Owanda put it precisely. The March 18th meeting will likely confirm that while the Fed's bias remains toward eventual easing, the geopolitical tax of the Iran conflict has significantly raised the bar for the next move. Raised the bar. Not eliminated the move, not reversed the cycle, raised the bar. So here's the full, honest answer to the question: did the Fed just feed the bull market? In the short term, no. Today's hawkish hold, with 7 members projecting 0 cuts, raised inflation forecasts, and Powell's patience language, is a headwind for gold and silver in the next 2 to 4 weeks. If you are a trader looking at the next 48 hours, today's Fed gave you a reason to be cautious. The initial knee-jerk reaction in precious metals will likely be negative. EBC Financial Group's analysis advised specifically that the first 24 to 72 hours after the Fed can be noisy, and the 1 to 3 month trend is more important than the initial reaction. In the medium term, the Fed today confirmed exactly the stagflation trap that is the most powerful long-term structural argument for owning gold and silver. Core inflation stuck at 3.1%, growth at 0.7%, oil above $100, war in the Middle East, a Fed that cannot cut because inflation is too high and cannot stay restrictive forever because growth is collapsing. That is not a normal economic environment. That is a stagflation environment. And stagflation has historically been one of the most powerful sustained drivers of gold and silver prices ever recorded. In the long term, the Fed today gave gold and silver investors the most important gift of all: time. Time to accumulate at prices that the structural bull market has not fully discovered yet. Time to buy physical metal before the hedge funds re-enter, before the ETF inflows accelerate, before Powell's successor, Kevin Warsh, inevitably faces the same impossible choice between inflation and recession and makes the same eventual pivot. The Fed did not feed the bull market today, but it did not kill it either. It extended the setup. And for investors who understand that the most powerful bull markets in precious metals history, the 1970s stagflation era, the 2008 crisis era, the 2020 pandemic era, were all built on exactly the kind of impossible central bank position that Powell described today, that extended setup is not a problem. It is an opportunity. Gold at $5,000, silver at $79. The structural case unchanged. The Fed trapped between inflation and recession. The war driving energy costs higher. The dot plot buying time before the inevitable pivot. Did the Fed feed the bull market today? Not directly, not loudly, not in a way that will make tomorrow's headlines. But in the only way that matters for long-term precious metals investors, yes, it fed it perfectly. Subscribe and drop your prediction in the comments. Does gold hold $5,000 this week? And where is silver when Powell's successor finally cuts rates?